The interest coverage ratio measures a company's operating profit relative to the amount of interest charges which the company pays. Interest coverage ratio is fairly simple to calculate. It is operating profit divided by interest expenses. And what does the ratio indicate? Well, it indicates the comfort with which the company can meet its interest obligations towards its debt holders. A higher interest coverage ratio then would indicate that the company can easily meet the interest expenses pertaining to its debt obligations. Let's understand this with the help of a real-world example. What we have here is the last 7 quarters of financial results of a company. And at the end, we have calculated the interest coverage ratio for each quarter, which is operating profit divided by finance costs, which gets you the interest coverage ratio. Now you will notice that as the profitability of the company declines, so does the interest coverage ratio. In particular, if you focus on the third quarter of financial year 2013, you will see as the profitability of the company declined sharply, so did the interest cover, and it fell below 1. Now think about what interest coverage ratio below 1 would indicate. It indicates that the company is not even generating enough so as to satisfy its debt holders, which leaves nothing for distribution amongst the shareholders. However, before you come to that conclusion, remember that based on the amount of debt with which the company operates, it is possible to predict the interest obligations for the company in a given year. However, a company's earnings and operating profit fluctuates more than its interest expenses, and therefore it is advisable to look at previous year's trends in interest coverage. Ideally, you should look at the average interest coverage ratio for the last 3 to 5 years or even more. In our view, interest coverage ratio of below 1.5 on a consistent basis should raise serious doubts about the company's ability to meet the expenses on its borrowings. And as we just saw, interest coverage ratio below 1 indicates that the company is just not generating enough to service its debt obligations, and that nothing is left for distribution amongst the shareholders after the company pays off its debt holders. Now before we end, let's take a look at a slightly more dramatic example for interest coverage ratio. If you look at Kingfisher Airlines, it has consistently been reporting operating losses for the last few quarters. On top of this, the company has huge interest obligations to pay off, given that it operates with a huge amount of debt on its books. This raises a serious concern about the very ability of the company to carry on for much longer. So the interest coverage ratio is an extremely important metric to look at, particularly in bad economic environment when the company's profitability goes down. In such a scenario, a higher interest charge could prove to be an extremely problematic situation for the company.